Good morning. Welcome to Good to Know Talk Series. Our focus here is to provide financial strategies and tax tips to help grow your business and save on taxes. We understand business owners are on the move and you need to know how information applies to your personal business. I'm your host, Janean Kong, and owner of Smart Tax and Business Solutions. I am a certified tax strategist and enrolled agent. I help you pay less tax through proactive tax planning. As always, we have James Kaw on the line. James is a financial advisor at Edward Jones. He's my trusted source for information in the industry, and he's here to answer questions and offer his expertise. James, how's it going this morning?
Doing well, and thanks for having me again.
Yeah, how was your Thanksgiving?
Ate way too much, therefore I had to run a lot, so to work that off. So I think I'm in a better place now. Yeah. How about
Yeah,
yours?
you know, I I got sick over the weekend. It was a bummer. I was, I had plans to get all these projects done over the weekend, and I didn't get to any of them because I was sick from Wednesday night all the way till Sunday.
Ah,
So,
I did hear about that.
yeah. Uh, yeah, so last week, James, you had talked about some retirement plans and generating deductions. I'm going to put you on the spot a little bit. Can you give our listeners who missed last week a quick recap?
Yeah, so based on if it's just a single man or woman shop, um, and if there's employees in the business, it really depends on, cash flows of the business, also employees to really customize a strategy and a plan that's going to be most beneficial to you, the business owner. So what myself and Janine do is we partner up to determine what's the best tax scenario for a business owner, and then what's the best investment strategy, keeping in mind numerous different types of risk, whether it be principal risk, inflation risk, business risk, or investment risk. But yeah, you know what? I'd first sit down with Janine or your tax professional to determine what type of business entity is going to be the most tax beneficial. And then thereafter, a financial advisor would come into play to determine what investment vehicle is going to be the most tax efficient and then also the most cost efficient for you.
Yeah, we have 5 weeks until the end of the year, and I'm sure it's the same for you, James. But our office is, I mean, we're busy trying to reach out to our clients and just sit down with them before the end of the year to see what we can do to maximize their deductions.
Yeah, and I just remind everyone, with Janine's proactive contacts and me with my clients as well, our bottom line is just really trying to help maximize what we can put in your pocket as business owners and then minimize what we need to send off to the IRS. But with that, there are specific rules and guidelines that, Janine keeps an eye on as far as taxes. I generally keep an eye on in terms of investments. But these proactive contacts, as we're reaching out to business owners and clients, it's really to benefit and make sure we could put more in their pocket and less in the IRS's pocket.
Mm-hmm. And if you missed, any of our previous episodes, you can, shoot us an email at info@smarttaxhawaii.com, and we'll send you the recording of the previous episode. Let's see, I wanted to, my goodness, my computer is running a bit slow this morning. I wanted to start this morning by just mentioning, so we have 4 main buckets of strategies you can use to cut your tax bill. The first bucket is timing-based strategies. So this is using a 401k deferrals to shift today's tax bill to tomorrow. We have income shifting strategies to move taxable income to lower bracket taxpayers like your children. And we also have code-based strategies like Section 105 that may let you deduct your family's medical bills as a business expense, for example. And then the fourth bucket is product-based strategies like separate managed accounts and insurance. Today, I want to look at a code-based strategy and really focus on a common mistake, and that's choosing the wrong business entity. Most business owners start as sole proprietors, then as they grow, establish an LLC or corporation to help protect them from business liability. But choosing the right business entity involves all sorts of tax considerations. And many business owners are actually operating with entities that may have been appropriate when they were established, but just don't work as effectively now. So let's start with the problem we're looking to solve today. And that problem is too much self-employment tax. Most businesses start out taxed as a sole proprietor. Even if the owner establishes an LLC, they usually elect the default tax treatment, which is a disregarded entity. This means that it's taxed as a sole proprietor. The owner will report the business net income on Schedule C. This business net income is subject to regular income tax. So when I talk about net income, this is your profit or what's left after expenses. The business net income is also subject to self-employment tax. So for 2017, this is 15.3% on the first $127,000 plus 2.9% on everything else. Plus, there's a potential 0.9% on amounts over $200,000 for individual filers or $250,000 for joint. So to recap, so far, your business has been taxed twice. Once at your tax bracket, let's say 15-20%, and then again as self-employment tax at 15.3%, plus possibly another 2.9% and even another 0.9%. And actually a lot of accountants dismiss the self-employment tax, but it adds up fast. So let's look at an example. We have a business owner netting $80,000. So this $80,000 again is their profit. After expenses, they have $80,000 left. Not counting their regular income tax, just on self-employment tax, this owner pays $11,304 in self-employment tax. And I should mention at this point, these rules work essentially the same if you're a partner in a partnership, meaning you're going to pay regular income tax on your partnership income and then self-employment tax on the same income as well. Now, I know what you might be thinking, that this self-employment tax might not really be a problem. After all, self-employment tax is what you pay in lieu of Social Security tax. So the money goes into the Social Security Trust Fund, where serious-looking bankers are carefully investing in for your future retirement, right? Doesn't it feel good to have a trust fund? But, unfortunately, that's not how it really works. Taxes go in and benefits come right out. Any excess actually gets invested in treasury bonds, which means Uncle Sam is getting your money right away. I'm not going to go into the politics of entitlement spending, but it's safe to say that few business owners are relying on Social Security for much of their retirement income. And I highly recommend you sit down with James for planning your future retirement. So let's get back to, let's look at our solution to our problem, which is the S Corp alternative. Establishing an S Corp, an S Corporation, solves our problem by dividing your net income into two halves. Sorry about that. Divides your net income into two halves. One of these halves is not subject to employment tax. So here's how it works. The corporation will pay you a salary for the service you perform as an employee. You'll get a W-2 for that amount, just like any other employee. The rest of the income will pass through to your personal tax return as a dividend. You're still going to pay regular income tax on both halves, so that hasn't changed. You're still going to pay on the salary and the dividend, just like you did your sole proprietor. You're also going to pay employment tax in the form of FICA withholding on the amount you take on the salary. It's the same 15.3% up to that $127,000 of Social Security wage base. But here's where the magic happens. You'll avoid employment tax entirely on the amount that passes through to you as a dividend. So let's take a look at our numbers again. So you remember the business owner we were talking about that was making, his profit was $80,000, and he was showing self-employment tax of $11,304 in self-employment tax. Same owner, if we establish an S Corp and pay this owner a $40,000 salary, we'll actually save $5,184 in employment tax. And I want you to keep in mind that this is especially valuable because we're simply eliminating a tax. We're not asking you to put $5,000 into a retirement plan and then deduct it, or take $5,000 and buy new equipment and then deduct it. We're simply avoiding that $5,000 in self-employment tax. It's a wonderful thing. Now, there is some fine print because I already know what you're thinking. Why not pay zero salary or a ridiculously low amount, like $1,000 a year? Well, rules require you to pay yourself a reasonable salary for the work you do as an employee for the corporation. And that's not always easy to determine. So the IRS and tax court, they look at several factors in determining what is reasonable. They'll look at the nature of the business. They'll look at the employee's qualifications, responsibilities, and how much time is devoted to the business. They'll also look at compensation compared with non-shareholder employees. They'll also compare it to other similar businesses, and even take a percentage of compensation compared to your sales. But every year, the IRS Statistics of Income Division publishes spreadsheets, reports of mind-numbing statistics. And this includes the average amount of salary that an S Corp owners in aggregate pay in the form of officer compensation. So in 2013, the percentage breakdown was 68% salary and 32% dividend. Now, I'm in no way suggesting you take this percentage as any sort of guideline or safe harbor. However, I do want you to see that using this S Corp strategy to minimize employment tax is a well-established mainstream planning strategy. Although there is another set of statistics that you might like. Organizing your business to be taxed as an S Corp can significantly lower your risk of getting audited. So we have a chart on the screen. You'll see that for 2014, the Schedule C audit percentages varied from 1% for returns grossing up to $25,000 to 2.4% for returns grossing $100,000 to $200,000. S Corp odds, in contrast, were just 0.4%. So less than 20% of the highest Schedule C odds. If we take a look at some nuts and bolts, basically there are two ways to skin this cat. You can do an actual corporation or you can do an LLC. Either way, you've got to register the entity with the state. You need to get an employer ID number, and you need to file the actual election, which is Form 2553. And my office can process this paperwork for you if you need help, but generally filing this election is pretty straightforward. Once your S Corp is all official, you'll have some ongoing paperwork requirements. You'll need to start filing payroll returns for yourself. You'll also need to manage state unemployment and workers' comp premiums. And you'll also need to adjust your own estimated taxes to reflect amounts you'll be withholding from your paycheck. And at the end of the year, you will need to prepare Forms W-2 and Forms W-3 along with a federal unemployment return and various state and local returns. And if payroll seems overwhelming, you can always outsource it to a payroll provider to handle all of this paperwork. You'll also need to follow some state formalities with your corporation, and these may not seem important, but if you ever end up, getting audited or sued, I'm glad you can show that you dotted your I's and crossed your T's. And so if you'd like more information or want to see if an S Corp makes sense for your business, I'm happy to sit down with you. You can call my office or email us at info@smart.com. And I wanted to leave some time to answer questions.
Janean? Can you hear me?
Mm-hmm.
Yeah. So for business owners, kind of what's the turning point? Is there, when you talk about net income or profits, and there may not be one size fits all, but what's the minimum net profit that you'd say, oh, okay, this makes sense for me to transition from sole proprietor to maybe an S Corp tax election? Is there like, whether that's 40,000, 60,000, what's usually the figure that business owners should say, hey, you know what, this may be a time for me to transition?
Yeah, that's a great question. And, it's such a personal question. I get asked that a lot, sort of what's the magic number. But, it comes down to, in our example, we had this owner who was profiting, 80,000 and he had a savings of $5,100. And for you, $5,100 might not be worth, all of the payroll and setting up the S Corp, but for some business owners, it's well worth it. So, as soon as you're showing a profit, I would sit down and just kind of see what type of savings there is, and then you can go from there. And it's not just for the tax savings. It also reduces your audit risk, and it provides liability protection. But yeah, great question.
And yeah, another thing that I realize, and that I think those that are tuned in, may not fall in this scenario for good reasons, is that, traditionally, tax professionals, if you're going to HR block, or if you're just doing it on TurboTax, people want a penny pinch in terms of, I don't want to have to pay for someone to do my taxes. But I think a lot of times, with clients, business owners, that have maybe a tax professional that strictly just does taxes and files them rather than looking at strategy. I think the huge benefit in what Janean, offers is just progressive, just being progressive with tax law and really developing a strategy. Because again, I have clients that have been in SEP IRAs when they should have considered maybe an S Corp tax election, being put on payroll. And once you're put on payroll from the investment standpoint, there's a lot more flexibility and opportunity to generate additional tax deductions. So when you're sitting down with a tax professional that's proactive, they're doing maintenance, they're doing strategy, I think that's a huge benefit, because just the amount that business owners may potentially save in taxes, the cost for advice and maintenance, the tax savings is going to far outweigh the cost for that strategy.
Mm-hmm. Yeah, that's a good point.
So I think there's a lot of strategies that myself and Janean are seeing. When people transition to the S Corp, there's an executive bonus plan strategy, and we touched on it a little bit last week. But you can discriminate who the bonus is going to be paid out to. So if you just want to bonus yourself as the business owner, that's completely in play, versus something like a 401k or profit sharing or a SEP contribution, in which you're most likely going to have to contribute to other employees. So I definitely recommend, no matter what the entity is set up right now, to sit down with Janean, and she could give you some guidance, maybe restructuring or utilizing a different entity to really maximize your tax savings.
Wow, thanks for that, James.
Yeah.
And next week we'll be going into some a little bit more advanced investment strategies that you'll need to actually show a payroll in order to contribute to these investments. So yeah, it really can make sense for your business. Let's see.
So I think Brent had a question in the chat. Did you see that? And I can read it to you.
If you don't mind.
Yeah. So would there be any situation where you would go into an S Corp and with income change to get out of the S Corp? In other words, changing when your business changes?
Possibly, if it's a temporary, situation, showing a loss on your S Corp, would actually just help offset your any other income that you might be showing, and that's sort of the beauty of the S Corp. So you, as owner employee, you have the option to either reduce your payroll for that year, or even stop it altogether if you're, if it's a particularly tough year. I wouldn't necessarily encourage dropping the S Corp altogether unless, the business is, just going to close, or it's, something major happens. But on the other side, if your S Corp were to grow, if your business were to grow, you might actually outgrow the S Corp. And there's other considerations, looking at a C Corp, for example. But yeah, it's, you can definitely change your business entity as your business changes.
Got it.
Okay, let's see. Well, if there isn't, did you see any other questions, Janean?
No, I think Brent was the only one that chimed in, so.
Okay, great. If there are any other questions, feel free to, send us an email at info@smarttaxhawaii.com, and either myself or James will get back to you. I think that's it. Have a good rest of the week, and we'll see all of you next week, same time, same place. And thanks, James, for being with us today.
Yeah, no problem. Hope everyone has a great rest of the week.
Thanks.
Okay, bye.